Hello and welcome to today's recording for the Premium Account Investor Signals Market Update for April 2017. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, Managing Director of Investor Signals. I have 18 years of experience in the financial services industry as a licensed securities and derivatives advisor. The topics for today, we look at the macro update driving equities. We roll through the ASX Top 50 with a focus on FY 17 and in particular FY 18 earnings. We look at the technical trends and the portfolio allocations and conclude with the short-term market outlook. The Premium Account Service is a model portfolio of ASX 50 stocks. We utilise call options and derivative options in general to enhance portfolio returns. We look at effective ownership around ex-dividend dates. We're generating above average cash flow while seeking capital growth. Using hedging strategies where required. It's all in a strict investment mandate, and importantly the assets remain in your name. If you'd like to know more about the service, please contact me on 02 or leon@investorsignals.com. Moving straight into a graph of the US market here and the Dow Jones. And let's start by just having a look at sort of when it was that we last had a 10% correction in US equities, and effectively began in late 2015, and the real sell-off accelerated in early January 2016, and the cause of this was the devaluation of the yuan and concern around problems in the shadow banking debt levels in China. Since then, the US equity market, and we're looking at the Dow Jones, rallied. It consolidated at resistance at around 18,000, and then in or around November we had the breakout up to 20,000, consolidated again, and then eventual rally through to 21,000. Right at the moment the market's pulled back and it's testing the lows of the recent sort of sell-off. Let's have a look at sort of what that means at the XJO level. So US equities are trading 18 times earnings, and in certain pockets of technology companies and industry leading companies, the PEs are stretched to 23, 24, 26 times earnings in the US. So, one could strongly argue that peak optimism is priced in to a large number of equities, and the supportive backdrop that's helped to drive equities at a macro level's under question at the moment. I'll talk more about that as we just roll through the top 50 stocks. Up on screen here is a graph of the XJO. If we look at our domestic market, we're in a series of higher highs and higher lows where the uptrends predominantly began in November. Right at the moment, the market's most recent support level is at 5,830 on the XJO. If we see the index trade below that, rally back up, find resistance there and start to roll over, I think investors need to heed that as a warning sign. Let's move straight into a graph of the top 50 stocks. So the first thing I do is come in here, make sure that I've loaded up the top 50 watch list, go back to the charts and begin toggling through the names. AGL, so I think this is getting very expensive up here on FY 18 earnings, allowing for 20% earnings growth over the next 12 months on top of the earnings growth the company enjoyed from 16 to 17. The stock trades on a 3.7% dividend yield. If they don't deliver the earnings growth that the market's expecting, they're on a 3% dividend yield. I think that's expensive for AGL. Most of the good news is priced in. We're not a buyer until mid-year when we see a pullback to much lower levels. I eventually expect at least a 50% retracement of this rally that AGL's had at the moment. Aristocrat recently just added to the ASX Top 50 index. The algorithm engine created a buy signal back in November on the low here of around 1365. And if we have a look at the prior algorithm signals, they've done a good job of picking up sort of the buying the dip throughout this accelerated uptrend. So we'll keep an eye on this, but eventually we'll see another more substantial pullback, probably back to around $16. We'd expect to see another algo buy trigger or reminder at that level, and we'll take a closer look at Aristocrat throughout the back half of this year. Amcor, so we don't mind this name, as I've spoken about a number of times. We see the stock mostly moving sideways. If we go back to sort of 2015 or even really maybe as early as early parts of March 2015. The stock's essentially at the same price today as what it was back then. Forward earnings growth is likely to be somewhere between 3 to maybe top side 8%. Puts the stock on about a 3.75% yield. If we look at the company delivering the earnings target into FY 18, puts it on a 4% dividend yield. We're comfortable owning it, but sell tight covered calls and boost that cash flow up to 20%, up to 10% plus on an annualized basis. AMP. Look, I think if once we get through this little washout that we're expecting in the market over the coming months, I think it's worth revisiting AMP as a potential long position in portfolios. Right at the moment, given our concerns about equity valuations, geopolitical risk, and just general slowdown, what I think looks to be a slowing of the US economy. We're seeing the GDP contract in the March quarter to the December quarter. We're seeing bond yields pull back in the US. Just on that note, let's see if I can just bring into screen a graph of the bond yields just so you can see what I'm referring to. So this here is the 10-year treasuries in the US. This here is approximately when US raised interest rates a quarter of a basis point. When we consider that the market was looking for 3 further rate rises over the course of this year, this is the actual yield on the treasuries has actually gone backwards. So normally if they're raising interest rates, you'd expect the forward expectation of this yield curve of yield return here on the treasuries to continue to rise in line with a bullish or improving US economy. It's actually going the opposite way. I think that's a reason for concern, or at least a reason for some caution at the moment. So AMP, if anything, we're positioned there on the short side of AMP for the time being. ANZ, I think if we see this break back down sort of below ultimately say $31, if it breaks back down, rallies back up, finds resistance again, I'd take that as a short-term warning sign on maybe the banking stocks have topped out. APA, so as we've seen those yields move lower in the US, some of these defensive yield names are performing better at the moment, but APA is not one of our preferred exposures. ASX, I had cautioned investors that at $52 this stock was getting very expensive. It was compressing down to sort of less than a 4% dividend yield. Ideally, we'd like to see it back at $45. That puts it on about a 4.5% dividend yield, and that would be very good buying down here. And that would tie in with sort of this old resistance level becoming new support. We've already tested it once, but I think in a weak market we may see it a little bit lower, which would create a great buying opportunity. AZJ, my concern here has always been that the company pays out 100% of its earnings in dividends. I think add to that the impact the Cyclone Debbie's had on the coal transport line access. I suspect that AZJ could be subject to earnings downgrades, and that very well may be the catalyst for the company to lower its dividend payout ratio. In that environment, the stock's worth $4.50, not $5.50, so we'll have a look at it later this year if we see that event unfold. BHP, so under Trump administration, we've maintained that oil and energy prices are likely to remain well supported. Generally, if you've got a backdrop of higher tension at a geopolitical level, then oil would normally do well, or energy would do well in that environment. That's a big part of BHP's portfolio. Right at the moment, iron ore prices have sold off heavily from, I think, sort of roughly $92 a tonne back down to about 66, so a reasonable retracement there by any measure, and we'll see that reflected in Fortescue and Rio in particular. BHP, we've got support here at around $23. In a weak market, I think it's feasible that BHP trades down at $21.50. But our strategy here is we actually don't mind owning BHP. If we're going to have exposure to resources, this is really the only name we hold, and we've sold covered calls up at around this sort of $26.50 level just to drive extra income, but mindful that we could see a breakdown to $21, and we'll look at using a stop loss to help protect or manage that position. Brambles, we've seen the company downgrade earnings from 8% earnings growth down to 3%. That's what's caused this sell-off. In hindsight, looking back here, the algorithm engines did a great job of sort of flagging the lower low structure as it broke down from this uptrend, and the stock's since sold off. Right at the moment, to the extent that we've been recent buyers of Brambles, we've sold the $10 covered calls, and that's turned a 3% dividend yield into 10% cash flow. Commonwealth Bank, As with all the banks, essentially the structure's bullish, higher highs, higher lows, but I just think now's the time to be very cautious. A break below recent support, rally back up, find resistance, and be cautious of further downside if that takes place. Computershare, I think this stock's grossly overvalued, especially in light of bond yields moving lower. So one of the reasons this stock's rallied has been a combination at a company level. They're cutting costs because they're mindful of sluggish revenue growth and deteriorating profits. So throughout this period here, we saw numerous profit downgrades from Computershare, and then with bond yields rising, the company cutting rates and having a small win in their shift to mortgage registration business. The market's got very excited about this. It trades now at around 20 times earnings on a 2.5% dividend yield. I think fair value could be back as low as sort of $12 there on Computershare. CSL, 20% earnings growth, uptrend. I think this is a really good story. In an ideal world, we'd like to buy back into it at lower levels. We do own it from roughly around the $100 mark, but as far as adding it to new client portfolios, if we get a pullback and we can buy back in around 110, that'd be a great opportunity to add a CSL across all client accounts. Caltex, I don't mind this. I see this as slightly defensive in an otherwise sort of increasingly volatile market. Trades 13 times earnings on just under a 4% dividend yield. Sell tight covered calls over it to enhance the return. Fortescue, so here's an example of the impact that the fall in iron ore prices have had. So only about a month ago, Fortescue's trading $7. Now it's at $5. We may find that it actually doesn't find support until around $4.55. We'll wait and see. Goodman Group, so this is quite an extraordinary performance here from a property trust that's growing earnings at about 6% per annum. The stock now trades on a 3% dividend yield, and what we've seen is money really sort of push into this name following the sell-off that we had at the end of last year. And then the acceleration here is really a byproduct of those US interest rate yields moving lower. So this would be something that I'd describe as a yield-sensitive name. So when interest rates go lower, these yield-sensitive names move higher. And GPT certainly fits into that group, and this has been one of our preferred exposures. So this is predominantly exposure to Sydney, Melbourne property, office trust, I should say. Trades on a 4.5% dividend yield. We owned it at lower levels. We've now just taken profit. When you add in the call option income, we've effectively sold the stock at around $5.40. For me, that sort of captures the full upside. Don't see it doing too much more above that in the short term. Insurance Australia Group, we like this name, trading 16 times earnings on a 4.7% dividend yield. Don't see too much growth over the next 6 or 12 months though, so therefore go out, sell covered calls at 6.25 and boost the cash flow. Turns a 4% dividend yield into over 10%. Incitec Pivot, with our concern around commodity prices, whilst we really like Incitec as a longer term story, we're just looking for value to re-emerge here in Incitec before we add it back into portfolios, and ideally we get to see it back at around 330 in the coming months before we look at adding that back into portfolios. James Hardie, a little like Computershare, I'm concerned here that this is overvalued at 28 times earnings and on 2.4% dividend yield. I'm concerned that we're going to see a correction in this name like what we've seen in a number of other high PE names over the last 6 months. Fair value for James Hardie may be back sort of more around $16, $17 if we see that correction play out as I expect to have happen. Lendlease here, I think, look, this name's done well. It's broken out, created higher highs, higher lows. It's always sort of been viewed as the best of breed within the property development space. It's on 12 times earnings on a 4% dividend yield. On a forward basis, they should grow earnings about 5-6%. In a stronger market, we'd be chasing this, but given our short-term concern over the next couple of months and just wanting to be a little bit cautious as to the way we're approaching asset allocations and portfolio protection, we're not chasing Lendlease at this stage. Mirvac Group doing well, 16 times earnings, 4.3% yield, not doing anything there though at present. Medibank Private, so we hold this in portfolios. We feel comfortable that this has a sufficient sort of defensive characteristic to it. It trades on about 14 times earnings and almost a 5% dividend yield. use a covered call to complement that, and we're getting about 10% cash flow and pretty comfortable that Medibank should hold up even in a volatile market. Macquarie Group, we don't like this name. We think it's fully valued up here, and again the risks are that we see it break down below support, rally back, find resistance and move into a more meaningful downtrend over the coming months. National Australia Bank, same applies there. We acknowledge higher highs, higher lows, looks bullish, draw a trend line under the lower, break below that, reason for caution. Newcrest Mining looks to be breaking out at the moment. We've been buyers of this over the past couple of weeks. We've done this through a call spread, so we've bought 22.50 calls and the stock's trading higher, and that call spread is performing well at this point in time. So it's interesting just to see this. Newcrest has traded up at 25.30 on Friday. Support's probably back down roughly at this level here around $24. So we may see a retest at some point at 24, and you'd expect the stock to then rally again off that. Origin Energy, this is performing well, higher highs, higher lows. We've got the company putting a number of its energy exploration assets into a separate vehicle and looking to list that later this year. Those proceeds will go towards retiring existing debt for Origin, which the market will be happy to see happen. That's probably the next catalyst to drive the price higher. Over the coming months, I expect Origin to really consolidate at or near these levels. Orica, so it's interesting as we look across some of these resource names. I'll just jump back to Origin. So we had an algorithm buy signal there at around $6 back in March, and the stock's since rallied. So as we move through these, let's just sort of comment on a couple of these. So we've had short signals predominantly through Orica throughout this downtrend. Right at the moment it's giving us a buy signal. My approach to any buy signals at the moment is to run stop losses below the recent low, given that concern at a macro level. Oil search looks to be breaking out, so higher highs, higher lows. We last had a buy signal down here at around $6. We had a sell signal here at around say $7.70, and the stock sort of corrected back to the low. We haven't had any further algorithm signals since. Maybe if we see a pullback to $7 could create a buying opportunity there in oil search. Qantas, concerned about this on the short side, a little like the banks, run a tight support line under there. If we see it break below, go up, test that and fail, I think that could be a trigger for the short side trade in Qantas. QBE started to break out as bond yields moved higher, starting to consolidate now with the fact that the bond yields in the US have pulled back. But at company level, things seem to be improving a little at QBE. But in order for the stock price to materially change higher, it does need to see those bond yields in the US turn around. I've got QBE trading at around 15 times earnings on a 4.5% dividend yield. On a forward basis, the company could grow earnings in low double digits. Ramsay Healthcare, we like this name. We've been minor buyers of it on this pullback here at around $63, looking for a target maybe back up to around $75. Then it's worth locking in the profit there. Rio Tinto, as with Fortescue, it's sold off heavily on the back of the iron ore prices pulling back. For me, it probably will test this support line here on a low of, say, $58. If we see it break below that, the next level of support could be back down at around $53. So just a little bit of caution there on Rio, and maybe take another look at it in a month or two if we see it back at around that 53 level. South 32, we had an algorithm buy signal here at around $2.30. The stock traded up as high as $3. I think it consolidates in line with our view that resources are a little under pressure at the moment. So here's one of the names that we like and we hold in client portfolios. Centre Group, this is one of those yield sensitive names. It's roughly trading on a 5% dividend yield. I think it's at around $4.50, $4.60, it's full value. We own it at lower levels. We've sold covered calls there, turning a 5% yield into a 10% cash flow return there. Stocklands, we're cautious of this name and not doing anything there at present. Sonic Healthcare, so this is a name we hold across most portfolios. It's on 20 times earnings, 3.5% dividend yield, and we've been aggressive with selling covered calls again, turning that 5% yield into 10% cash flow. Santos, not really doing there at the moment. Suncorp, we had a series of sell signals off the algo engine as the stock was making lower lows and lower highs. It appeared that we had sort of another confirmation of that back in December at around $14. We took that as an opportunity to sell Suncorp, and we effectively delivered the stock of $14 with a combination of sort of the $13.75 sell level in the stock plus the call premium. It achieved an exit price of around $14. The stock appeared to be moving lower, but now we've possibly got a support level here at around this $12.75. If the stock holds above that and consolidates, the picture looks a bit better, but if we start to see it come back down and test that, I've become pretty cautious there on Suncorp. Sydney Airport's another one of these yield-sensitive names that we hold, and it's performed very well, up at around $7, $7.25. I think it's full value. That puts Sydney Airports on about a 4.5% yield. Don't see it compressing too much beyond that. Transurban, we like this name, coming into its June dividend. It'll be paying a dividend of around 25 cents. The stock trades on about a 4.3% dividend yield, and it's enjoyed this strong rally as those US interest rates have pulled back. I think at $12 it's full value, and you want to either take profit or sell tight at the money covered calls to enhance the return. Telstra, looking back here, we've had numerous short algo signals here, and the most recent one at 5.25 back in January has proven to be a great selling or shorting signal for the stock, and it's moved lower since then. From a fundamental standpoint, I suspect that the market's probably having a bit of an overreaction to TPG's entrance into the 4G mobile space. I suspect that Telstra has a couple of years of enjoying similar profit margins, and obviously the flow through of the large NBN payments, which will underpin the current dividend payout, but obviously the market gets a little more concerned from 2020 onwards, and there's a bit of a readjustment taking place in Telstra at the moment. I'd be surprised if we don't see a rally in Telstra of some description coming into the August dividend, with the stock now pushing sort of up above 8% dividend yield. Treasury Wines, we like this name. We'll wait for the next algorithm buy signal before adding it back into client portfolios. We have owned it on occasions throughout that uptrend. And then Westpac, higher highs, higher lows. Again, if we see it break below, rally back, test that, fail, that's our strategy on the banks, and we want to be positioned on the short side when and if we see that happen. At 14 times earnings, it's on about a 5.3% dividend yield, and the market expectation for the banks is to deliver about 3 to 5% earnings growth. Wesfarmers, so look, interesting this name, with the potential spin-off of their resource division over the next 12 months and the return of capital to shareholders. Wesfarmers is likely to remain a stock that's worth keeping on your watch list. If we see market weakness occur and a pullback in Wes to around $42, we'd take that as an opportunity to accumulate Wesfarmers. Westfield, another yield-sensitive name that's doing very well. It's trading about 21 times earnings on a 3.7% dividend yield. It's rallied from $8.40 to $9.30, so it's put on about 10% over the course of the last month. At around $9.50, the stock's full value, and you should be selling covered calls to boost that return. Woolworths, I think this is full value up here. The recovery in the stock price is done, allowing for 90 cents of dividends over the next 12 months. That puts the stock on about a 3% yield. I think that fully values Woolworths, so happy owning it, but sell very tight covered calls to make the risk return worthwhile. Woodside Petroleum, so energy prices are broken out, higher highs, higher lows. With Woodside, if we see a pullback to around 31, 32, we might take a closer look at it. And there we are back to the index. So the core message at the moment is that we're running some inverse ETF exposure, so ETFs that go up in value when the market goes down, and we're also running some put spreads on individual stocks to capture sell-offs at a broad technical level. When looking at the market, I think you need to be cautious if you see the market breaking below these supports, and this in particular applies to the banking stocks. If we see the market break down, rally back, struggle, and then start to sell off again, I think given sort of where we sit with sort of peak optimism in equity markets, high valuations, geopolitical risks, uncertainty around central bank stimulus remaining both in Japan and Europe, interest rates increasing in China, interest rates increasing in the US, slowing US GDP. So there's a whole raft of issues under the surface that I think should make investors cautious at the moment. And for that reason, in client portfolios, we're being very defensive and building up the hedging and strategies to profit from the downside of the market. So if you'd like to have a chat with us about how we can help with your portfolio management and implement some of those protective measures on your ASX portfolio, please give me a call on 02 or email leon@investorsignals.com. Thank you.